Day trading is one of the greatest ways to gain market exposure. Due to the short duration of the trade, one ends up taking many such trades over their trading career, giving them sufficient experience of various market types. So, while an investor experiences a bearish market once in a while, a day trader is going to experience this perhaps every quarter. Consequently, a day trader is tested for their abilities to navigate different market types since markets do not remain bearish always, just like they do not remain bullish always, and the changes are the fastest in this particular time frame. For the purpose of day trading, it is my recommendation that the assessment of the trend must happen on the hourly chart. And at the end of the day, I have set the Nifty 50 chart on the hourly time frame. And any assessment done here will be applicable only for the next day's trade session. And after the day trade session closes, the assessment done today will not be carried forward. That is, fresh assessment needs to be done on the chart again, and this process needs to be repeated. So let us understand how we will assess such a price chart. The difference between a monthly and the hourly is the duration for which a trend sustains itself. As I mentioned earlier, that a day trader is going to experience various trend types, not just bearish or bullish, but also bearish and bullish trends of various degrees of strength. And it becomes very important to understand not just the direction but also the strength of the market, because this governs what positions, what type of positions the trader is most likely to take. So once again, having set Nifty charts on the hourly time frame, the question is how do we assess the trend here? For the purpose of assessment, there are various methods. For example, connecting the pivotal highs with one another, we will notice that each pivotal high is lower than the previous, suggesting that the trend is on the downside. But like I said, that when it comes to day trading, we cannot have a simple down or up view only. We need to have a certain assessment of the strength of the trend. For that purpose, I will include two moving averages, which are the 20 and the 50 moving average, and focus on the last crossover that we can see. Since the date of this crossover, obviously we can note that the market has continued to trade on the downside. The first time the market reacted from a point of potential support, we will see that the reaction rally took it to a point between the 20 and the 50 period moving average. Given that this reaction rally is at a point between the 20 and the 50 period moving average, I will mark this retest zone as a value zone test. In other words, whenever a security has a throwback between the two moving averages, I am saying that this security is in a value zone. And logically, in the value zone, one would require to check for some bearish tactical confirmations in order to initiate shorts. Subsequently, we note that the second test happened only till the 20 moving average, which means this is in the bearish strong zone. That's largely because here the market has only rallied till the first moving average. The subsequent test happened till the bearish weak zone, since the market has moved all the way to the 50 period moving average. After a new low has been created, we can see that once again the market is testing the bearish strong zone. In other words, what we note here is that we have a bearish crossover, a market that has failed to go at any point in time above its 50-hour moving average, which means the strongest possible description of the trend could be bearish weak, and the market is showing intermittent signs of being a bearish strong trend also. Now the question is how do we translate this information into trading activity for the next day? For that, if we select a simple indicator called the ADX, we will see that the value is above 25. As I have mentioned, that if ADX if ADX is greater than 25, then the recommendation would be to buy the options. If so here, whereas if ADX is less than 20, then the option would be to write the options. ADX between 25 and 20, that is ADX between the 20-25 range, should be considered as a no trade zone, because it will be unclear at that time if the market is trending or if it is ranging. Since we can see that the ADX is above 25, the intention would be to buy the option. Since we have seen that the direction is on the downside, the intention now would be to buy the put option. So here, buying the put option. But the question is, which put option? What will be the strike price and what will be the trade plan? For this, I will add another indicator called as the average true range. Here we will note that the value of the average true range is approximately 50 points. Since my reference points are the two moving averages that I have selected on the screen, with the highest point being at 22,744, which we can see on the right side, if I add 50 points to it, I am likely to reach the level of 22,794. In other words, I'll just change this color here to green and darken this line. So this dark green line represents the stop loss for our sell side positions, and the question is, where would the sell side positions be initiated? The sell side positions would be initiated on the strong, which means here, and these lines could be slightly lighter and dotted, at the value zone, which is at a midpoint of the strong and the weak, and finally the weak moving average. In other words, we can see that there are 3 points where it is possible for the trader to short. The trader who wishes to trade it like a strong bearish trend will sell the first gap up in the morning. A trader who wishes to trade this as a value sell trend would wait for approximately 80 points up move in the morning before initiating a sell. Whereas the trader who's trading it in the weak category would wait for an up move of nearly 200 points in order to initiate the sell. And where would they exit the trade? They would logically exit the trade at the green line, which is roughly 22,795 at spot levels. Using this as reference and the fact that we have identified that this is a trending security, our plan will now be to buy 22,800 PE with an SL of 22,795 at spot levels, which will loosely translate to a rupees 5 SL on the PE. And where would we sell them? We just note the red lines marked, which is 22,560, 22,680 and 22,750. These would be the 3 points potentially where a trader could initiate the sell. At each point, we will note that the value of the PE will begin to depreciate by close to 100-150 points. We also understand the lot size of the put option, which is currently at 75. Given the understanding of the spot levels where we want to initiate the sell, the spot levels at which we want to exit, the trend, the lot size, a trader has all the information that they need in order to plan the next day's trade. The intention of this video is not to give a trade recommendation for tomorrow. Rather, it is to outline one of the many processes that exist in order to plan a trade in advance. 95% of traders get into the market without even having done the most basic assessment on any chart. The idea of this video is to demonstrate or outline a simple process which you could potentially use in your day-to-day trading activity, particularly at the end of each trade session. And as you work on this process, you will find many places in which you can improve and a reason to learn many more new things. With this in mind, I wish you all the best.